Hello, welcome back. So one of the patrons of our channel who is actually using the tool has asked me a very interesting question and I wanted to dedicate a video on it. He actually asked me how you can actually deduce, what's the proper way to deduce the projections values to use here. And I wanted to dedicate a video and tell you about how I go about finding the correct values, or some values at least, to use for my projections. Now you have to know that there is no correct values or incorrect values here, but you don't want to be too off. You want to go by the financials of the company. And so here's how I go about it. So the first thing that we project here, first of all, we're taking a look at Meta platforms. For now, I'm going to check two companies. I'm going to check Meta and Ford for this example. Ford is a little bit different, that's why. Now, Meta Platforms is a company that has relatively steady stuff going on, relatively steady revenue, net income, free cash flow. So this is going to be an easier example. Ford is going to be a little bit more complex. This is why I'm choosing both. Now, you will see here the revenue of the company from 2017 to 2021 keeps increasing. Over here, you see the revenue growth every year. So from 40 to 55, the revenue growth 37%. The previous year, from 2016, if it was available here, it grew 47%. Now, 2019 grew 26% from 2018. So basically, it's a growth number of the revenue every year. And what we want to be doing here is we want to project what is our expected return for the company in the next 5 years. And so in order to do that, we examine past history because we have historical data. We know how the company operates. And this little table here tells you the averages of this historical data. So you have the 5-year average here as well, which is a little bit handy, but you also got it here. It's the same value. It's the 5-year average of all these returns over here. It's 33.97%. So if you sum these up and divide by 5, you're going to get this value. Now, this one is the last 3-year average. It's a little bit less because 2019 and 2020 were not that great for the company in terms of revenue growth, of course, which is pretty good still, but not as great as before. And so the 3-year average goes down to 28%. And last year they did 37, which is very, very cool, very, very nice. And it was similar to 2018 pretty much. So you have the handy little averages here, which can help you deduce which kind of values to use. Now, potentially, if you get a report about Facebook, Meta, getting some guidance that tells you that the revenue is going to go down lower next year, maybe you can actually give it a little bit of a discount in your projections because you're expecting it to be lower. So typically speaking, when you are examining a 5-year discounted cash flow model such as this one, you want to be using values that are kinda conservative but not extremely conservative. If it was like a 10-year discounted cash flow model, you would probably want to go lower. So what does it make sense to use here? So the 5-year average 34% could make sense, although I want to be more conservative. I don't want to be that high because the company could underachieve in a few years, and at some point large companies will lose some of their growth. They will not be growing at the same rate. And so I like to give this very high value a little bit of a discount. So let's just say I'm fine with 20%. I'm gonna go with a low of 20% here. Or actually, let's go with a medium of 20% actually. And be like, okay, I think 20% is achievable from this company. Actually, they have done 21.6. It's their worst year in the last 5 years. And so 20 I think is achievable for a medium estimates. Now, if things get worse, maybe I want to go 15, just to have a little bit of a leeway here. And in case things get better, I can also try to go 25. So this is how I'm deducing potential revenue growth values, projections for the year. These are percentages. This is 15%, 20%, 25%, which are basically based off of the previous years, pretty much. Now, the next thing is net income margin. What is that? Net income margin is the relationship of the net income that the company posted to the revenue that the company posted. Because when the company sells things, it needs to be making some profit out of these things that they sold. And so if they sold 40 billion, how much of this 40 billion is actual profit is the question. And this is the number here. From 40 billion in revenue, the company made 16 billion in net income, and that margin is 39%. So 15%, almost 60 billion of 41 almost billion is 40% of 40% margin or net income to revenue is what this is. So this number is basically 40% of this number is what I'm saying. And the same thing with all the other years. We're seeing a table of net income margins here. comparing net income, dividing net income to revenue, pretty much. And so the net income growth is also useful because we can see how quickly the net income has been growing through the years, kind of gives us an idea. But for our next values here, we're using the net income margin because we want to know how much of the company's revenue was transformed to net income. That's the question in terms of a percentage. And we're having in the previous years 34, 31, and 33. 5-year average is 34. You also have that here, as you'll see. 31 is the 3-year average. 33 is what they did last year. And so what we do want to make do here is also be a little bit conservative, but not too conservative, because we don't want to go too low and actually miss on the net income that the company will be generating. We have already factored quite some in the revenue growth here, so we can go relatively high with this one and be like, we don't want to overdo it, of course, and we can try all sorts of values and be all sorts of confident or conservative, really. But let's just say that I'm going 28, give it a little bit of an extra margin here, 30 and 32. And later I could also try like 30, 32, and 34 even. So the next one, free cash flow margin. What is this one? Now the free cash flow margin tells us the relationship between free cash flow and net income. So because net income can be skewed by all sorts of things, and it's the actual free cash flow that is what provides value to the company for the most part. It's what the company keeps after capital expenditures. It's the operating income minus capital expenditures. And so because net income can be skewed by all sorts of little tricks, really, we want to make sure that this kind of profit generates free cash flow, and not that we have a company that generates net income and then its free cash flow is like zero or close to that. So this is why we're using this sort of relationship of free cash flow margin, as I'm calling it, and it's not a margin to the revenue, it's a margin to the net income. It tells me that 17.48 billion here is 109% of 15.93 billion. And the same thing happens with all the other years, like this cash flow is 69% of this value, the net income. And so you can see how much of our net income basically turns to free cash flow. And we're using this free cash flow margin so that, again, we get a sense of how much free cash flow is provided by the actual net income of the company and not by tricks that companies can deploy, such as, for example, depreciation, amortization, and stock-based compensation, which can skew our numbers if net income is negative. And so again, we kind of look at the averages and we go near those. We can use something in between again. We can have our base value out of all these three, or even use the 5-year average. Let's just say we use it here, 95%. And then I go 90 on one side and 100 on the other side. The annual return that I typically like to get is 13%. The reason for this is that, this is the discount value of the model, really. The reason is that 10% is what an ETF makes, like an S&P 500 ETF makes about 10% a year. With a single stock, you have more risk, and so you need to be making more money for taking up that risk. And so this is why I'm using 13%. You can use any value you like, actually, of course, but something close to 12, 13%, I think is fair. And if you have a more risky company, then you may want to go even higher. And if I hit calculate with these numbers, you'll see that I'm getting three values here. This is the low, the medium, and the high one, and this is the current price of the stock as it's trading right now as I'm speaking. What does this tell me? It tells me that if these projections were to come true for the next 5 years, then it makes a ton of sense for me to buy the stock today for a max price of $272. Now the stock is 205, so this is a green light for me to buy today. And for these projections, the max price would be this one, and for these projections, the max price would be this one. And let's just say that we're more conservative investors and we want to take a look at the worst case scenario. Let's just go 8%. Now the company is going to grow 8, 10, and 12%, significantly failing its previous years, as you can see, in terms of revenue growth. Now we hit calculate again, and now it's only the low one that it's pretty much where we are sitting over here. It's practically speaking the same price. So if you believe that the company will grow at least 8% for the next 5 years, then buying Facebook right now is a no-brainer pretty much, based on the discounted cash flow model. And so this is how it works. Let's take a look at another company, Ford. I'm gonna switch to Ford numbers now. Now this is a little bit more weird, more complex here. Why? Now the revenue, you will see again, it's posted here with percentages, and some years are negative, and these really skew the averages here. And this is why the 5-year average is negative, and the 3-year average is negative. Last year is positive. So this here is a company that is not making great revenue growth, as you can see. It's not posting great growth, and has actually lost revenue since 2017. This is a case where you could even go negative. You could be like, okay, I'm expecting that the company will be -1 in terms of revenue growth, and then it will be, let's just say, 1 and 2, using the highest numbers that I can get. Now, the net income margin for this one, again, you see here, generally speaking, it's about 3-4%. 13% is last year, is the odd one out. They did very well that year, but we cannot go with the highest one. So we need to go somewhere in between. I'm going to go 3, 4, and 5, basically utilizing these numbers and a little bit above those for my high estimates. And the free cash flow margin, this is where things get tricky here, because the company has been posting weird years every year. So for instance, this is a 7 billion net income, 3.6. This is 47 million only, and this is a loss. And this is where you see the importance of the free cash flow margin here. Now, you will see that the free cash flow growth here is negative, and the net income is, as you see, sorry, my bad. The free cash flow is positive, the net income is positive as well. And so we're getting a free cash flow margin of 145%, which is the relationship between the free cash flow and the net income over here. But the next year, you will see again the same thing. 7.2 billion, 3.6 billion, same thing, 196, it's almost double. But take a look at this year. Now this year is having $10 billion in terms of free cash flow and $47 million in terms of net income. So we already know that this was skewed because of some entries in the free cash flow model of the company. We can, of course, deduce exactly what happened. We discover exactly what happened with the company if we go to the cash flow statement. And you will clearly see here that while the company had pretty much no net income after reducing all the expenses, it's depreciation and amortization that got added back to the free cash flow, which actually increased the cash flow and made it positive, made it a positive value here. You will see it in below. Let's go back. Now, you will see this one is an amazing value, but now you know that this is the odd one out. This is not to be trusted, really. It's not going to be happening every year. So you can basically safely sort of like exclude it from your averages. And now we're having one year where the free cash flow was 18 billion, and then the net income was minus 1.2 billion. Similar story here. We're having negative free cash flow, which is very similar to what could have happened this year if the net income was slightly lower, as you'll see. And this is why we're using this relationship. It can really tells us with just by viewing the data exactly what has been happening and how we should be treating that. And now the next year, 2021, was a more normal year again, 9.5 billion to when divided to 17.94 billion in terms of their net income, gives us about 53% for the free cash flow margin compared to the net income. And so here we have the averages again, and what are we using here? Now, going by the averages here is not best, of course, as you can understand, because of these unexpected years. We have to use some values that typically make sense for companies. This would be around 100%, could be like 90, 100, 105, and 110, and also try to be close to what the company has been posting beforehand. Now, again, this kind of data can be a little bit all over the place. You see 145, 196, 53 here. I typically, when I see these kinds of values, I tend to like to go somewhere in between. So I tend to go something like 80, 90, and 100 here. And of course, you can try all sorts of different scenarios. But for my revenue growth, let's just say minus 1% and 1 and 2 here. And the net income margin, I'm going to go 3, what I said earlier, 3, 4, and let's go 6 here, something like that. Or 5, let's go 5. And an annual return of 13%, pretty much what I typically like to use. Whoops. And again, these are projections, and we can play with these and see what kind of different values we're getting with different projections. And so when I hit calculate for this one now, you will see that with these projections, the current price is a go for our medium estimates here and not a go for our low estimates. Now, if we switch it up a little bit, and remember this was negative growth, for example. Let's just say that we have minus 5%, so the company does terribly bad. Now this one will skew our lower results, and because we have less revenue growth, we will have to buy lower, as you can understand. Now, if you expect 1%, this makes more sense. And now if I play a little bit with free cash flow margins here, you will see how that affects my results too. Over here, let's just say that I'm trying these values now, and I'm expecting this, and this is also skewing my results upwards because now the company is posting more free cash flow compared to their net income. Now, I hope that gives you an idea of how to use the tool. I tried to be a little bit too insightful with providing all sorts of information about how to go this. I hope that really helps. And if you have any question, please leave a comment below, and I will definitely attend to it. But this is the core idea about how we use the tool and how we use a discounted cash flow model. It's all about projections about the future based on the historical data, and you can take a little bit of a look at what analysts are saying potentially. But I personally myself like to use historical data and go lower to what the company has been achieving in order to have a little bit of a margin of safety. And this is how I do my discounted cash flow models. And you can use the tool, you have access, and you can play with all these values and see what works best and what makes the most sense for you based on the numbers that you are seeing over here. And I'm explaining how to go about it with all sorts of companies that I'm analyzing in my videos, and hopefully this one kind of gives you an idea of how I go about the whole process. Again, thanks for watching, thanks a lot for your question, and thanks for being a Patreon. I hope you guys enjoyed this video, and I'll see you soon. Bye bye.